Welcome, everyone. In today's video, we're going to delve deep into the concept of a stock market bubble. This video will cover the intricate details of what a stock market bubble is, how one develops, notable historical examples, the economic implications of a burst, and how to identify potential bubbles before they occur. Let's start with the basics. A stock market bubble occurs when stock prices significantly exceed their intrinsic value, usually driven by exuberant market behavior. It often ends with a sharp decline in prices once the bubble bursts. For example, consider the dot-com bubble from the late 1990s. During this time, internet-based companies saw their stock prices skyrocket. Investors excited by the potential of the internet poured money into these companies, often without looking deeply at their business model or financial health. The intrinsic value of these companies' stocks was far lower than their market value. When reality set in that many of these companies wouldn't deliver the expected returns, the bubble burst, leading to a significant market crash in the early 2000s. Next, let's discuss the main phases of a bubble. Typically, a stock market bubble has 5 phases: displacement, boom, euphoria, profit-taking, and panic. During the displacement phase, a new innovation or paradigm shift causes a re-evaluation of asset values. This is followed by the boom phase, where prices rise as more investors enter the market. The euphoria phase is marked by a runaway increase in prices fueled by speculative behavior. In the profit-taking phase, savvy investors start to sell off their shares, recognizing that the market is overvalued. Finally, the panic phase sees a rapid contraction in prices as the broader market realizes what's happening. But how can we spot a bubble before it bursts? One key indicator is the price-to-earnings (PE) ratio, which measures the current share price relative to its per-share earnings. Historically high PE ratios can suggest that a market is overvalued. Let's take an example. During the housing bubble in the mid-2000s, the average P/E ratio for housing-related stocks reached unprecedented levels, indicating that stock prices were disconnected from the company's actual earnings potential. Another useful indicator is market sentiment. High levels of public enthusiasm for stocks, driven by media and societal buzz, can point towards a bubble. This is often matched by increased trading volumes, as seen during the cryptocurrency surge in 2017. One of the most crucial questions is, how does a bursting bubble affect the economy? When a bubble bursts, it can lead to massive financial losses and a reduction in consumer wealth, often triggering broader economic downturns. For instance, the 2008 financial crisis, triggered by the housing bubble burst, led to the Great Recession, one of the most severe economic downturns since the Great Depression. It affected global economies, leading to increased unemployment and reduced economic output. Now, let's consider another example closer to recent times: the COVID-19 pandemic and the stock market's reaction. Despite a severe economic impact, many tech stocks saw unprecedented rises in their prices. Some analysts argue that this is another bubble in the making. The S&P 500's technology sector saw massive gains during the pandemic. Yet, if we compare these gains to the earnings reports, there may be a disconnection hinting at a potential bubble. Let's pause for a moment. Do you have any questions so far? Feel free to drop them in the comments section below. Question: how important is it for an average investor to understand stock market bubbles? Answer: understanding stock market bubbles can significantly impact an average investor's strategy. Recognizing the signs of a bubble allows for more informed decisions regarding buying or selling assets, helping to mitigate potential financial losses during a market correction. Question: can a bubble be beneficial for any economic sector? Answer: while bubbles typically have negative connotations due to their eventual burst, certain sectors can temporarily benefit from the influx of investment and increased visibility. However, these benefits are often short-lived and can lead to long-term instability. As we approach the end of our discussion, it's worth reflecting on the long-term lessons from past bubbles. Diversification remains a critical strategy. By spreading investments across various asset classes and sectors, one can reduce the risk of significant financial loss from a burst bubble. Moreover, staying informed through diligent research and staying wary of overly optimistic market sentiment can prove invaluable. The role of financial advisors is also crucial, as they can provide professional insights and guide investors during volatile periods. Remember, markets can be unpredictable, but a thorough understanding of stock market bubbles can equip you to navigate through tumultuous times more effectively. Use this knowledge to make more informed and balanced investment decisions. Thank you for watching. If you found this deep dive into stock market bubbles informative, please like, share, and subscribe to our channel for more financial insights and tips. And remember to leave your questions and thoughts in the comments below. Until next time, stay financially savvy.